Hello everyone, and thanks for tuning into the Financial Investor channel. My name is Brent, and today we're going to be doing stocks with ExDividend next week. I'm going to try and go through this very quick. It's almost 1:30 in the morning. I had to work tonight. Just got wrapped up not too long ago doing some network changes. So I'm going to go ahead and go through this with you guys from start to finish, looking up stocks that have ExDividends next week and doing the screening process on them. And it's a very quick screening process. We screen them versus the S&P 500, yield and PE, price earnings ratio, and then I also look for stocks that have increase in revenue, net income, free cash flow over the last 10 years positive. Then we look at stocks that are either trading below or above their 200-day moving average, and a couple other little things. So let's go ahead and get into it. So over at dividend.com, clicked on ExDividend Dates. I'm going to go ahead and deselect everything here besides my common shares. For next week, I'm going to go 1st through the 7th. You know, next week really market's only open 30 through the 3rd, but I'm going to go ahead and just select those weekends as well. Hit search. If you have a login for dividend.com, it's completely free. You're going to have these DARS ratings. If you'd like to know how they're rated, you can take a quick look right there. Just stop the video and you'll see here that highly rated is 4.6 through 5 and recommended is 3.6 through 5. So I like to take everything that's at a 3.6 and up. So here really JP Morgan and up is what I would go. CSCO number 1, right behind is Horizon, Medtronic, Quest Diagnostics, and a few others. So there's a couple stocks in there. I have no idea what they are. Obviously I know what CSCO is, but all I do here is I grab the stocks here that have a rating of 3.6 and above, put them over into my spreadsheet. So this week we're actually going to have a very low count of 29 stocks. So of these 29 stocks, a few of them are unqualified or qualified. So here there's a little qualified dividend. It says either yes or unknown or no, meaning that the stock, if it's a qualified dividend at the very end of the year, you'll be able to, depending on your tax bracket, you'll either be taxed like a 0% tax bracket or 15% tax bracket, or you'll have a bit of qualified dividend. If it's not qualified dividend, you'll have to pay taxes on that dividend at your regular income tax bracket, unless you're trading within a retirement account, such as an IRA or Roth IRA, which I trade primarily in. And okay, so here we have our stocks, we have our rating, we can see our ExDividend dates here are coming up next week. We have our payout dates. Some of these are towards the end of the month. We can see how much they're paying out per share. We can just put the number on there. Oh wait, that's not, oh yeah, that is it. So that's how much they pay out per share, and then how much they're currently priced, and it gives you their yield based on their current payout and their current price. You can see that a few of these, such as CSCO, has a current yield on cost of 3.10, and there's a couple here, UFC. So actually, without even having to put these into my whole screening process, I can actually eliminate a few of these right off the bat. So right off the bat, I don't like to add anything into my grouping that has a yield less than 1.5. So right there, I kept 1.43. It's very close. And let's go ahead and add the remainder into these. So I just knocked off a couple. I'm down to 20 now. So I'm going to go ahead and resort these by, why don't you let me resort, insert one above. And we're going to go ahead and go from highest to lowest. There we are. And starting at the top, so our strongest stocks are going to be here up on top. And then as we move down our list, our stocks towards the bottom are going to be less, you know, those are going to be a little bit lower rated stocks as far as how dividend.com rated them. And we're going to take a look at financially what their metrics look like. And let's see what our stocks end up being. Normally we end up with around we had 11 stocks, I believe, last week. We got Disney coming up next week, so that's a pretty nice buy right now. I know Disney, that was one of the stocks I covered in the Dow Jones. If you watch my Dow Jones video, one of the unloved stocks right now in the Dow Jones is currently down, but it has really good revenue, net income, free cash flow. Now, this whole process that I go through doing this, I go to dividend.com, I pull a bunch of stocks. 90% of them I have never heard of. The only stocks on here that I recognize right off the bat are Cisco, JP Morgan, and Disney. I think those are 3 out of the 20 stocks. I mean, if we multiply that by 5, 5 and 3 is 15% of the stocks that I'm kind of covering right now. Oh, we have Comcast in there, so that's 4 by the 5, so 20% of the stocks that I'm currently screening. I have the other remaining 80%. I have no idea what they do, what their metrics look like. So this whole process is why I do this. So I already did it for the yield. Next, I'm going to go ahead and deselect a few of these down to about 12. And I'm going to go ahead and screen them for price earnings ratio. Currently under 25. S&P 500 average, I believe it's actually crossed over the 25 zone. I can actually check that real quick. My ExDividend Dates. So here, S&P 500 is currently at a 24.78. I rounded up to 25 for that PE ratio, and then dividend yield is currently at a 1.84, but I round down for that one at a 1.5 because there are some stocks out there such as Apple, Nvidia, let's see here, Starbucks that may have lower yields, but are still great growth plus dividend stocks. So here I'm just going to go ahead and remove stocks with high PE ratio over 25. So Bristol here, this blue color, it's about the 5th one up. So I just kind of scroll up, 5th one up. Orange, 2nd from the top. Go ahead and remove that. And now we have everything there, less than 25 PE ratio. So I go ahead and deselect these ones, reselect my next couple of stocks here. And again, we have PH that has a very high PE ratio. We got that purple one there, that NetApp. We have HopFed, haven't heard of it, but it's gone. So during this whole process, I don't, the names themselves, I don't look at the names. Cisco, for example, I believe they deliver food all around. Right now, all I'm doing is knocking them out based on my screening process, my financials that I screened them for. So now they've been screened for PE ratios under 25, yields greater than 1.5. Next, I like to look for revenue, net income, free cash flow, all positive over the last 10 years, percentage-wise. So here I go down to data format, look at as a percentage. Cisco, for example, I was invested in Cisco back in 2017, sold off my position in 2018, right around January, February, I believe. Great looking stock here, double-digit growth over the last 10 years. But of course, take that number, divide it by 10 years that this graph is showing. So here, their revenue is 2.2% year over year, 1.93 year over year for their free cash or their net income, and 1.77% for their free cash flow. So very steady, healthy growth. You can see here between 2016 and current, they're not really moving as far up right now. They're changing their they're transitioning from being a hardware supplier more into security. We have a lot of their products where I work. That's what I was doing tonight. I was rolling out some security. So Horizon Bancorp, here we got some triple digits. So here, basically just divided by 10, 26% year-over-year net income growth, 21% revenue growth, 20% free cash flow growth. So it's all great. So I'm going to go through here, knock out any of these stocks that currently have any sort of negative numbers. You can see most of these towards the top are going to be, high rated on Dividend.com. And as we move here towards the bottom, some of these here towards the bottom may have some negative revenue, negative net income over the last 10 years, where we'll just kind of knock those ones off our list to not be potential lookups here. So this whole process, I started with 29 stocks. I'm now down to 2, 4, 6, 8 potential recommendations that I could then look at a little bit further. And so here now I can take a look at, okay, price to earnings ratio right now, price earnings ratio in the future, and taking a look, go back to my data format original. So current PE ratio is in the blue, futures in the orange. So here I want orange to be below. That would mean that earnings in the future are expected to grow, meaning that their current price that they're at and their future earnings, their PE ratio is going to be dropping just because they're going to be getting more earnings. So we want that orange on the bottom. And I wouldn't remove a stock due to this. I would just be wary, You know, this stock, its price earnings ratio is expected to grow in the future, meaning that their earnings are expected to decline. Maybe they put out an in their earnings report that in next quarters coming up, they're not going to be growing as fast or not as much. So Disney, for example, that's one that potentially their earnings could be down as they're kind of transitioning, taking on more debt. You know, they're making offers on Fox and kind of transitioning and starting their own streaming service. So maybe in the future, they're going to be reinvesting those earnings into their company instead of having it there on the balance sheet. Comcast there, orange is over the blue by quite a bit, almost double. So current PE ratio is at a 6.7. Future forward is at a 13.1, so very high there. So a couple of things I like to look at. So during this process here, I won't remove any stocks now. All I'm looking at is their numbers. So here, for example, Cisco, we have price earnings ratio less than 25. It's at a 21.89. Its price to sales and price to book is at a pretty good, you know, it's not extremely high as compared to other stocks out there. You can see Johnson & Johnson, for example, I believe theirs is a bit high, or a couple of those. Many value investors like to buy stocks that have a price in comparison to their sales or price in comparison to the book value of the company of under 3. So this one, for example, I would consider that fair valued, but at the same time, in the past, it had came down quite a bit. Let's go to our 3 years here. So just over the year, for example, you can see here steady. Last year, I bought this back in July, I believe, of 2017, at very nice discount price, and that was where it was in the 3s. Now it's a little bit into the 4s. Still a great buy and hold stock. Horizon there, PE in the 20s. Its price to sales at a 4.9. Its price to book, so book value, if you took all the assets in the company and took the price of the current stock, multiply it by the number of shares out there, the price to book value would actually be at a very near match, only at a 1.1, so very slightly off there. Quest Diagnostics, again, right around 3, actually under 3 there for that price to sales. Good PE ratio there. CVB Financial Group, price to book value is over 1.5, depending on if it's a financial institution. When I looked up, if you're looking to buy a financial institution, it'd be good to aim towards a company that's assets, its price in comparison to its book value is around 1.5 and below. A couple of examples we'll throw in here. I'm not sure what JP Morgan or Goldman Sachs are, but if we look at JP Morgan, we'll see that their price to book is at a 1.55. Goldman Sachs price to book is at a 1.1. If we look up Wells Fargo, price to book is at a 1.4. So when you're buying financials, that's something I like to look for. One stock I owned in the past, New York Community Bank Corp. This had a price to book value less than 1. I purchased it, wrote it up very nicely, sold that one off. But just giving you an example there. So this one, price to book value is a little bit high. I would look into why that's much higher than other financial stocks within that same sector. McCormick, we have good PE ratio, came down very fast here after their first earnings. That is because they put out earnings that blew expectations out of the water. Their current price in comparison to their earnings, the gap closed very quickly. Their PE dropped, and they're at a 17.27. 4.5 price to book, which is lower than the average for the year, and their price to sales is right about average, or it's about the same as it has been for the last year. GNTX, good PE, kind of in that zone. Their price to sales, price to book is kind of slightly coming up. Disney, PE ratio has been coming down as their earnings are growing and growing, and they're going to be buying up Fox. They're going to be creating their own streaming services, doing all sorts of productional stuff and streaming services. I believe they're going to be doing some big changes here in the future. I definitely see Disney continuing to grow in their earnings, and they're currently priced right around $100, so very, very discounted stock. And price to book 3.4, price to sales at a 2.8, which is right along for the year, if we look at this over the last 5 years, it's actually not that bad, right on track, and you're actually getting it at a very good PE ratio in comparison to its past, almost near back in during that recession period here in 2008-9, and then again prior to 2012. So great buying opportunity there if you guys are looking to buy Disney. Then we have Comcast. Comcast earnings grew, they were at a price earnings ratio up in the high, looks like maybe 18. So quite a while in the 18s. Their earnings again, 2018, that tax reform earnings and a lot of companies grew. I know my buddy over in the telecom sector, he works in this whole sector with Comcast, CenturyLink, Charter. They put out bonuses. They raised, they're all union, so they got a lot of, all that extra earnings went towards employees, also went towards infrastructure and building up, CenturyLink, for example. I think I already said that one, but Comcast, just one of those infrastructure companies, and grew their earnings quite a bit. It went from an 18 PE ratio down to a 6.7, but again, their expected forward PE ratio expected to come back to 13.13, which is probably right along the line. So maybe they had a weird first quarter, and they might bounce back that way, which could cause their stock to kind of come back down because their future expectations declined. But price to book value is very low at a 2.1. Price to sales is also low at a 1.7. Now, of these stocks, which ones are currently priced either above the current average for the year or below the current average for the year? Cisco, for example, yield is below the price right now for the year, meaning that it's trading over the average right now. So this could be, I would kind of wait off on this one maybe slightly for a little bit. I mean, it's still a great buying opportunity. The yield on cost is great. Cisco has 7 or 8 years of raising their dividend now, and is transitioning more to security, which is perpetual. You're paying for that licensing yearly, year-over-year contracts and stuff with other companies and such. So Cisco's where it's at as far as infrastructure. You're not going to be using Netgear or Jupiter or any of those other brands out there. Cisco is much easier to work with. So Horizon Bancorp, we have price over yield, but if you had bought this one back in, looks like sometime during April, you could have got a yield of nearly 1.84, a price a little bit below $19, but this one's steadily been growing. So as they, if we add their dividend here, they probably did a dividend increase here. Yeah, so you can see their dividend, they increased their dividend here, which caused their yield to kind of keep up with their price. So as their price kind of moves up positive, they also increase their dividend, which kind of keeps it balanced throughout that time. So let's go ahead and move on to Quest Diagnostics, price over yield. You can see here that this one does swing where the price comes down, yield goes up, price kind of mellows out. So this one, you could wait a little bit. You could get it at near $100 maybe in the future, with trade war talks that's going on. I'm not sure how this one would be affected by it. CVB Financial, price over yield. Don't know a whole lot on that one. McCormick, price over yield. GNTX, price over yield. So not a lot of these. Disney, that one, if you had bought this during April when that price was below $100, back in October area when that price was below $100, that would be great buying opportunity. Still a great buying opportunity. Just buy it now and buy on those dips, because it may dip below $100 for just a few days here and there, but overall long term, if you want to see this over the long term, their dividend, they've been paying out dividends since back in the 1980s. Great long term. We'll look at dividends here in just a second. Comcast, look back at the year here. Comcast has came down in price as of January 2017. Their earnings expectations going forward, you saw their PE ratios expected to grow. That may have caused a sell-off in their stock, which is why their stock has came down. If you look at this over just say the last 3 years, if you wanted to get this sort of a price buying opportunity, you would have had to have bought the stock back in anywhere prior to November area of 2000. Let's see, this is 2016 here. So in 2016, towards the end of the year, you would have had to have bought this right around that $32 range, and then you could have rode it into the $40 range. But it has very good steady growth. If we bring in dividends in here, looks like they've been paying out dividends since back in the 80s as well, but there could have been times where they had either slower dividend growth, or you can see these higher, much faster dividend increases there after 2010, after we came out of that recession. And see here. Okay, so I want to look at price in comparison to the 200-day moving average. If we look at CSCO, CSCO here is currently, let's look at it over the last 5 years. You can see that CSCO, for example, is trading above the 200-day moving average. Horizon Bank Corp above that 200-day moving average. Quest above slightly. So this one did come down at a great bond opportunity here prior to 2018. CVB Financial, it's actually priced below its 200-day moving average. Financials have been getting hammered. If you look at Goldman Sachs, JP Morgan, you know, the financial ETF, XLF, I believe. There's a couple good financial ETFs out there. We're waiting for, we need the financials in the market to move towards higher highs, and right now we're not seeing it, even though they've had good earnings such as Goldman Sachs. So McCormick trading slightly over that 200-day moving average. GNTX, again, right above that 200-day. Walt Disney, it was trading below that 200-day moving average. I know a whole lot of people in the dividend stock group community, in the Facebook groups, that bought Disney on that dip below $100. So great buying opportunity. Comcast currently priced below that 200-day moving average. And you know, Comcast throwing out those offers on Fox, all cash buy, but I know they're trying to build up their infrastructure. There's a huge push towards media getting in front of the consumer's face in order to, you know, ads and all sorts of products and features and all sorts of stuff. So big push that way. And Comcast could go that way in the future, such as AT&T has, DirecTV. And let's go ahead and move over to Dividend.com now. So we move towards Dividend.com. What are we at? 22 minutes. I'm going to go ahead and try and wrap this up as fast as I can. So I'm going to grab CSCO and HBNC and DGX. And all we're going to do here is take a look at how long each of these have been paying out dividends, BF, and put them in order. And then from then, we'll kind of go over when their ex-dividend is. Obviously, it's next week sometime, but we'll try and get specifics on there. So if any of you guys out there are looking to buy Disney to capture that dividend plus ride it up into the future, then definitely do that. Why is my Disney not popping up? Just gonna skip over that. So CMCSA. Okay, so my other ones aren't popping up. So yeah, my internet's not loading there. I'm gonna go ahead and copy that one. Disney and CMCSA. Okay, well, we got a couple of these loaded. I'm not sure if my internet is dying. Yeah, it looks like maybe my internet's dying. It's 2 o'clock in the morning. Maybe they're in some sort of updates. So I will have to update this a little bit later in the morning sometime and then head to work. But anyways, so CSCO Systems, we have 7 years of dividend growth. Payout ratio slightly over 50%, but still not a bad buying opportunity. Their ex-dividend is on the 5th of July, which is Thursday. So you'd have to buy this on the 4th of July, probably actually on the 3rd of July. I don't know if the markets are closed on the 4th. Probably. So you'd have to buy it on Tuesday or prior. Here we have Horizon Bank Corp, 4 years dividend growth. Great payout ratio. Ex-dividend is on Thursday. Again, have to buy it on Tuesday or prior. We have DGX. We have Quest Diagnostics, Medical Laboratories. Very good payout ratio, 6 years dividend growth. Ex-dividend is on the 6th of July, so you could actually buy this one on Thursday, have it for the ex-dividend on Friday, and then get those ex-dividends paid out. We have CVB Financial, ticker symbol CVBF, Regional Pacific Bank. Ex-dividend is on the 3rd, which is Tuesday. You'd have to buy this one on Monday or prior, and then you get paid out on the 19th of July. By McCormick, ticker symbol MKC. MKC, processed and packaged goods. Good payout ratio, could lose half of its earnings, still pay out to their shareholders, and still have some left over in order to earn or reinvest into their company. Dividend growth, 31 years. That goes into first place. ExDividend is on the 6th, so that's Friday. You would have to buy it on Thursday or prior. You'll then get paid out on the 23rd of July. Let's see if I can refresh these and make these appear here. Oh, we got Comcast and we got GNTX. Ticker symbol GNTX. Auto parts, very reasonable yield. Payout ratio very low. Again, could lose half of its earnings, still pay out to shareholders. Dividend growth 7 years. ExDividends on the 5th of July. That's on Thursday. You have to buy on Tuesday or prior. Then you would get paid out on the 18th of July. So quick turnaround there. We have Disney. Disney, 1 year of dividend growth. Great payout ratio. ExDividend on the 6th of July would be paid out in the end of this year. So since they said they've been paying out since 2017. So you can see here that Disney had been paying out annually up until 2015, where they went semi-annually. So instead of paying out shareholders one chunk every single year, they went semi-annually. So they paid out 2 times. They cut their dividend there. It looks like a dividend cut. But if you take $1.15, divide it by 2, that's 50, and then 7, so 57 cents. That actually increased their dividend. They cut it, but it's 66 cents, and you're paying out twice. So you're actually getting that 66 plus 71. And I can't do the math. 60 and 70, that's what, $1.20 something. So definitely a very good raise there. And then just have steadily increased it, continuing to pay out semi-annual. So this little thing here where it's dividend growth, you always want to double check it. That's why I want to showcase Disney, for example. Someone had corrected me on another video when I covered Disney. So definitely don't take this little number here and say, oh, dividend growth 1 year. I'm not going to invest in Disney. Look towards the bottom, or pull up some sort of other charts that shows you how long the stock has been paying dividend, because Disney has been paying a dividend since back in the 80s. And great looking stock there. Comcast, 7 years, great payout ratio. July 2nd, that would be on Monday. So you'd have to actually buy that stock this Friday or prior. And ticker symbol CMCSA. And you would then get paid out on the 3rd. Oh, on the 25th of July. I was like, why would they have the date after? Okay, so 25th of July. So if we put these in order, we have McCormick at 31 years, followed up behind by Disney at some 20-some years. We then have, let's see here, without going and doing a little bit further research on some of these other ones, we then have Cisco, Comcast, and GNTX in 3rd place with 7 years of dividend growth, and then followed right behind by DGX, 6 years of dividend growth, and then here CVBF Financial and Horizon Bank Corp. So these financial institutions, they've been getting kind of hammered lately, so I would not avoid them, but look into them. Why? You know, always do a little bit digger deep. You know, if you'd like, I have a strategy up on my website. If you head over to the financial-investor.com, I got my strategy as far as, you know, I go over their financial metrics first, and I got my list of 5 stocks. Now I can do a deeper dive. Instead of a list of 50 stocks, I have to do a deeper dive into. I'd rather consolidate it down, go over here. We have 2, 4, 6, 8 stocks. Would any of those interest any of you guys out there? Let me know in the comment section below. It's much easier to research 8 stocks and look at their balance sheet, look at their moat, who are their competitors, what products or services do they offer, will those products or services be needed in the next 3 to 10 to 20 years, you know, whatever your expectations of being involved in that stock are. And there's a couple other things I like to look for as well. I can't think of them off the top of my head. We're hitting almost 2 o'clock in the morning. We're at 30 minutes now, and I think we're going to be calling it right there. So hopefully that has been a good informational video covering how to get stocks with ExDividend next week, screening 29 stocks, getting 8 of them that are very positive with PE ratios less than 25, dividend yields over 1.5, rising revenue, net income, free cash flow, all over the last 10 years. Very positive, nice steady growth. Some stocks double-digit growth year over year. Some stocks single-digit growth year over year. Then only one of them is trading below. I think 2 of them are actually trading below 200-day moving average. I believe Disney had been, but I believe those financial stocks were trading below that 200-day moving average. And then, of course, we went over what days you need to buy them next week, or Comcast, you'd have to buy it this Friday to be eligible for that ExDividend next week. So if there's any questions, I know this video is a little bit fast, and it's 2 in the morning. I wanted to get it done. I didn't want to say, put it out, not do it. But if there's anything you guys would like to have covered in future videos or information that could be adjusted a little bit, let me know in the comment section below. I'm always looking to improve my content, and if there's any stocks you guys would like screened or looked at, let me know as well. So that's it for this video. Thank you all for watching up to this point. If you did like the video, remember to like, comment, and subscribe if you're brand new and have not. Hit the notification button and to be notified of all upcoming and new videos on my channel I release weekly. As a friendly disclaimer, I am not a financial advisor or tax professional. The information provided is my opinion for entertainment and fun. This is not investment advice. This is just me as a financial investor myself, trying to help others make the money work for them, looking for some great deals out of the market right now as we're going into that trade wars. So that'll be fun. All right, guys, I will see you later. Have a great one. Bye.